If your mutual fund charges a 1% fee, that really does not sound like much, right? 1% is a penny on the dollar. It feels negligible. It feels like a rounding error. But here is the reality that almost nobody in the financial industry wants to explain clearly. Over a 30-year timeline, that single 1% leak can quietly drain around 25 to 30% of your entire retirement portfolio, compared to a low-fee alternative. I'm not talking about losing a few $100. I'm talking about the difference between retiring in comfort and working an extra 5 years. Today we are going to talk about the expense ratio. It is the invisible hole in your investment bucket, and if you do not plug it, it will bleed your wealth dry without you ever seeing a bill. I call this the invisible bill because, unlike your cell phone or your mortgage, you never actually sit down and write a check for your mutual fund fees. You never see a transaction on your bank statement that says minus $500 for fund management. Because you do not see it, you do not feel it. And because you do not feel it, you ignore it. But the math is ruthless. Today, I'm going to walk you through exactly how an expense ratio works, how to calculate the massive damage it does over time using a simple bucket analogy, and most importantly, how to check your own portfolio in about 5 minutes to see if you are currently bleeding money. If you are new here, my name is Tom, and I like to read the fine print on financial documents so you do not have to. If you appreciate deep dives that respect your intelligence and protect your wallet, go ahead and subscribe. Honestly, spending the next 30 minutes understanding this concept offers a higher return on investment than almost anything else you can do today. Fixing a high expense ratio is the only free lunch in investing. It is guaranteed money back in your pocket. Let's get into the mechanics. Let's start with the definition. What is an expense ratio? Most people assume that when they buy a mutual fund or an ETF, the cost is just the commission they paid to buy it, or maybe the spread. But the expense ratio is the ongoing operating fee charged by the fund company to keep the lights on. It covers the portfolio managers, the fancy office buildings, the marketing budgets, and the administrative record keeping. It is expressed as a percentage of your total investment. If you have $10,000 invested and the expense ratio is 1%, you are paying $100 a year. That sounds reasonable on the surface. But the trap is thinking of it as a one-time fee. It is not. It is a recurring subscription to your own money that gets more expensive the wealthier you get. To understand the math, you have to look at how the fund calculates it. The formula is the total annual fund expenses divided by the average net assets of the fund. For example, if a fund manages $200 million in assets and it costs them $2 million a year to run the operation, that is a 2 divided by 200 calculation, which equals 1%. That 1% is the expense ratio. It applies to every single dollar you have in that fund. It does not matter if the fund went up 20% that year or down 20%. The manager still gets paid their percentage. This is a crucial distinction. In many businesses, you pay for performance. In the fund world, the expense ratio is a tax on assets, not a tax on profit. You pay it just for the privilege of holding the shares. Now, you might be thinking, okay, Tom, I can handle a yearly fee. I will just pay it in December. But wait, it gets sneakier. You do not pay it in December. In fact, you never pay it directly at all. This is where most investors get tricked. The expense ratio is deducted quietly, behind the scenes, every single day. They take the annual rate, divide it by the number of days in the year, and subtract that tiny fraction from the fund's net asset value, or NAV, before the market opens. When you check your account balance, the money is already gone. The return you see reported on Google Finance or your brokerage statement is the net return. The fee has already been scrubbed from the record. It is like a termite infestation in your house. You do not see the bugs eating the wood. You just notice that 10 years later, the floor is sagging. I want you to visualize this using a bucket. Imagine your portfolio is a large metal bucket that you are trying to fill with water. The water represents your investment returns. In a perfect world, you pour water in and the level rises. But the expense ratio is a small hole drilled into the side of the bucket. Every single moment, a tiny stream of water is trickling out. If the hole is small, say 0.03%, it is just a few drops. You barely notice it. But if the hole is 1% or 1.5%, it is a steady stream. And here is the physics of it. The more water you put in the bucket, the more pressure there is, and the faster the water leaks out. The fee grows as your wealth grows. Let's put some numbers to that leak. Mathematically, your wealth growth is roughly your gross market return minus the fee. If the underlying stock market goes up by 7% in a year, that is your gross return. If you are in a cheap index fund with a 0.1% fee, you keep roughly 6.9%. You captured almost all the value. But if you are in an expensive active fund charging 1.1%, you only keep 5.9%. Now, losing 1 percentage point of return sounds like a nuisance, not a disaster. But this linear thinking is where our brains fail us. We are not wired to understand exponential decay. That small gap between 6.9% and 5.9% compounds over decades into a canyon. I want to prove this to you with a hard example. Let's run a 30-year simulation. We are going to assume you start with a lump sum of $100,000. We will assume the stock market gives us a gross return of 7% per year, which is a fairly standard historical estimate adjusted for inflation. In scenario A, you are a smart investor who bought a low-cost index fund with an expense ratio of 0.10%. So, your net return is 6.9%. You leave that money alone for 30 years. You let the compound interest work its magic. At the end of 3 decades, using the future value formula, your $100,000 has grown to approximately $760,000. That is a solid result. You turned 100 grand into $750,000. Now look at scenario B. You bought a fund that looks identical. It holds the same stocks. It has the same gross performance of 7%. But this fund has a fancy name and charges a 1.10% expense ratio. That is just 1% higher. So your net return is 5.9%. We run the same math. $100,000 growing at 5.9% for 30 years. When we open the account 3 decades later, the balance is approximately $550,000. Pause there for a second. In the first scenario, you had $760,000. In this scenario, you have $550,000. The difference is over $200,000. Let's contextualize that loss. You did not just lose a few pennies, you lost $210,000. That is an entire house in some parts of the country. That is 5 years of living expenses. If we look at it as a percentage of your potential wealth, that extra 1% fee ate about 27 to 28% of your final portfolio value. Think about that. You took 100% of the risk. You put up 100% of the capital. But the fund manager, by charging just 1% extra, confiscated a quarter of your ending wealth. This is why Vanguard and other major providers warn about costs so aggressively. It is not just about saving money. It is about keeping the compound interest for yourself rather than donating it to a financial institution. Most people stop the math there and think, well, I still made money, so it is fine. But this is the opportunity cost trap. That missing $200,000 isn't just missing money, it is missing security. It is the money that would have paid for your grandkids' college It is the money that would have paid for long-term care. And here is the twist that makes it even more painful. I used a flat $100,000 investment. If you are adding money every month from your paycheck, the raw dollar amount of fees you pay is actually much higher because you are constantly feeding the beast. The more you save, the more they take. It is a system designed to penalize success unless you opt out of the high fee structure. So, what should you be paying? What is considered normal? It depends on what you are buying. If you are buying a passive index fund or ETF, like one that tracks the S&P 500 or the total stock market, you should be paying very little. Major providers like Vanguard, Fidelity, and Schwab have been in a price war for decades. For these funds, a good expense ratio is anywhere from 0.03% to 0.20%. If you are paying more than 0.2% for a generic US stock market index fund, you are essentially overpaying for a commodity. It is like paying $10 for a gallon of milk that costs $3 at the store next door. The milk is exactly the same. On the other hand, we have actively managed funds. These are funds where a human being is picking stocks, trying to beat the market. Their expense ratios are significantly higher. They usually range from 0.5% all the way up to 1.5% or even 2% for specialized sectors. The argument here is that you are paying for expertise. You are paying for a smart team to navigate the market for you. But remember the math we just did. If an active manager charges 1.5%, they have to beat the market by 1.5% every single year just to get you back to even with the cheap index fund. That is a very high hurdle to clear consistently. History shows that the vast majority of them fail to do it over the long term. There is also a relationship between the size of the fund and the expense ratio. Generally, larger funds can afford to charge less because they have economies of scale. It does not cost 10 times as much to manage $10 billion as it does to manage $1 billion. This is why you will often see the massive funds from BlackRock or Vanguard with those tiny ratios. Conversely, small funds, international funds, or niche funds that trade illiquid assets naturally have higher costs. It costs more to research companies in emerging markets than it does to buy Apple and Microsoft. So, seeing a slightly higher ratio in an international fund, maybe around 0.4 or 0.5%, is more forgivable. But the rule of thumb remains, lower is better, all else being equal. We have been focusing on the expense ratio, but I need to let you in on a little secret. The expense ratio is not the only cost inside a fund. It is just the only one they are legally required to print on the sticker. There are other costs that are completely invisible. One of them is trading costs. When a fund manager buys and sells stocks, they pay commissions and bid-ask spreads. Those costs come directly out of the fund's assets, but they are not included in the expense ratio. If you own a fund with high turnover, meaning the manager trades a lot, you could be losing another 0.5 or 1% a year in transaction costs without ever knowing it. This is another reason why low turnover index funds tend to win. They just sit there. They do not trade, so they do not rack up these hidden bills. Why do so many smart people still hold these expensive funds? It comes down to psychology. Human beings are terrible at judging small percentages. If I told you a car cost $50,000 and the dealer fee was $500, you would say, okay. If I told you the dealer fee was $5,000, you would walk out. But when we see 1%, our brain categorizes it as small. We see the raw number 1 and think it is insignificant compared to the return of 7 or 8. We fail to see it as a percentage of the total pie. The financial industry knows this. They know that if they sent you a bill for $2,000 every year for holding their fund, you would cancel it. So they hide it in the percentage. There is also an incentive problem. Many financial advisors, especially those who are paid on commission, are incentivized to put you in funds with higher expense ratios. Why? Because sometimes a portion of that expense ratio is kicked back to the firm or the broker. These are called 12b-1 fees. It is a marketing fee hidden inside the expense ratio that pays the person who sold you the fund. If you are in a fund with a 1% fee, it is possible that 0.25 of that is going straight to the broker's firm every year, forever. If you are in a cheap index fund, there is no kickback. So, if your advisor is pushing a high-fee fund, you have to ask yourself, is this fund actually better, or is it just paying a better commission? This is why understanding the expense ratio is a self-defense mechanism. Now, I want to be fair. Is there ever a time when a high expense ratio is justified? Rarely, but yes. If you are trying to access a very specific, complex strategy, you have to pay for it. For example, if you want exposure to private equity, or distressed debt, or a highly complex quant strategy that requires a supercomputer to run, you cannot get that for 0.03%. In those cases, you are paying for access to an asset class that you simply cannot buy on your own. But for the vast majority of us who are just trying to save for retirement with stocks and bonds, those complex strategies are unnecessary. For your core portfolio, paying high fees is like buying a Ferrari to drive 10 miles per hour in a school zone. It is a waste of resources. So, how do you fix this? The first step is to audit your portfolio. You can do this right now. Log into your brokerage account or open your latest statement. Look for the ticker symbol of your funds. It is usually a 5-letter code for mutual funds or 3 to 4 letters for ETFs. Go to Google or Morningstar and type in that ticker. Look for the line that says expense ratio. If it is 0.05%, 0.1%, or even 0.2%, you are green. You are in the safe zone. If you see numbers like 0.8, 1.2, or 1.5, red lights should be flashing. You need to investigate why you own that fund. Is it performing so amazingly well that it covers that fee? Probably not. Before you rush to sell everything, a quick warning. If you are holding these funds in a taxable brokerage account, selling them triggers capital gains taxes. You do not want to sell a fund to save 1% in fees, only to pay 15 or 20% in taxes to the IRS immediately. You have to do the math. If the capital gains hit is huge, you might just be stuck with it, but you should stop adding new money to it. However, if these funds are in an IRA or a 401k, you are in luck. You can sell and swap funds inside those retirement accounts without triggering any immediate tax event. That is where you should be ruthless. Go into your 401k, look at the options, and swap the high-fee junk for the low-fee index options. It is a tax-free upgrade to your future wealth. I want you to adopt a personal rule, the 1% rule. Treat any expense ratio over 1% with extreme skepticism. In fact, treat any ratio over 0.5% with suspicion. In the modern era of investing, costs have come down so much that paying high fees is almost a voluntary donation to Wall Street. There are very few active managers who deserve that money. By keeping your costs low, you lower the bar for success. You do not need to find the needle in the haystack. You just need to buy the haystack and not pay someone a fortune to watch it for you. To wrap this up, let's go back to our bucket. Your financial life is about filling that bucket. You work hard for the water you pour in. You take risks investing it. Do not let a hole in the side of the bucket undo your hard work. That 1% leak does not look like much today, but over 30 years it drains 25% of your potential. That is money that belongs to you. It belongs to your family. It does not belong to a fund manager's marketing budget. By simply being aware of the expense ratio and choosing low-cost funds, You are effectively giving yourself a massive raise. You are plugging the leak. And the best part is, once you fix it, you never have to think about it again. It is a permanent fix. Here is my request to you. This week, check just one of your accounts. Look up the expense ratios. If you find something shocking, like a fund charging you 1.5% for a generic growth strategy, drop a comment below. I want to hear the horror stories because it helps others realize they aren't alone. And if you found this breakdown helpful, if it saved you from that $200,000 loss, hit the like button so the algorithm shows this to more people who need to plug their own leaks. Thanks for listening, and I will see you in the next one.